Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Investors buy shares in the mutual fund, which represent a portion of the fund's holdings. The fund's investment objective and strategy are defined in its prospectus. The fund's portfolio is managed by professional fund managers who make investment decisions based on the fund's objectives and market conditions. Mutual funds offer investors a way to invest in a diversified portfolio of securities with relatively low minimum investment amounts. Mutual funds may charge fees and expenses, such as management fees and operating expenses, which are paid by the investors in the fund. The performance of a mutual fund is typically measured by its net asset value, NAV, which is the value of the fund's assets minus its liabilities divided by the number of shares outstanding. Investors may buy or sell mutual fund shares at the NAV price, which is calculated daily. How does a mutual fund work? A mutual fund works by pooling money from multiple investors and using that money to buy a diversified portfolio of stocks, bonds, or other securities. Here's how it works. 1. Investors buy shares in the mutual fund, which represent a portion of the fund's holdings. 2. The mutual fund then uses the money it has raised to buy a diversified portfolio of securities that align with the fund's investment objective and strategy. 3. The fund is managed by professional fund managers who make investment decisions based on the fund's objectives and market conditions. 4. The fund's performance is measured by its net asset value, NAV, which is the value of the fund's assets minus its liabilities divided by the number of shares outstanding. 5. The NAV is calculated daily and represents the price at which investors can buy or sell shares in the mutual fund. 6. Mutual funds may charge fees and expenses, such as management fees and operating expenses, which are paid by the investors in the fund. Investors can buy or sell mutual fund shares at any time, and the price at which they buy or sell is based on the NAV at the time of the transaction. Overall, mutual funds provide a convenient way for individual investors to access professionally managed, diversified portfolios of securities with relatively low minimum investment amounts. They also offer liquidity, as investors can buy or sell shares at any time. Advantage of mutual funds? Mutual funds offer several advantages to investors, including 1. Diversification. Mutual funds invest in a diversified portfolio of securities, which helps to spread risk across multiple investments. This reduces the impact of any single investment's performance on the overall portfolio. 2. Professional management. Mutual funds are managed by professional fund managers who have expertise in investing in securities markets. This allows investors to benefit from the knowledge and experience of these professionals. 3. Accessibility. Mutual funds have relatively low minimum investment amounts, making them accessible to a wide range of investors. This makes it easier for individual investors to build a diversified investment portfolio. 4. Liquidity. Mutual funds are generally liquid investments, which means investors can buy or sell shares at any time. This makes it easy for investors to access their money when they need it. 5. Convenience. Investing in mutual funds is convenient, as investors can buy or sell shares online, by phone, or through a financial advisor. 6. Cost effectiveness. Mutual funds offer cost-effective investment options, as the fees and expenses associated with the fund are shared among all the investors. This allows individual investors to benefit from economies of scale. Overall, mutual funds offer a convenient and cost-effective way for individual investors to access professionally managed, diversified portfolios of securities, which can help to reduce risk and potentially increase returns. Disadvantage of mutual fund? While mutual funds offer many advantages to investors, there are also some potential disadvantages, including 1. Fees and expenses. Mutual funds charge fees and expenses, such as management fees, operating expenses, and sales loads, which can reduce an investor's returns over time. 2. Lack of control. Investors in mutual funds have little control over the investment decisions made by the fund manager, and may not be able to choose the specific securities in which the fund invests. 3. Market risk. Mutual funds are subject to market risk, which means that the value of the fund can fluctuate based on changes in the securities markets. 4. Performance risk. While professional fund managers aim to outperform the market, there is no guarantee that a mutual fund will perform well, and some mutual funds may underperform their benchmarks. 5. Tax implications. Mutual funds can have tax implications for investors, including capital gains taxes and taxes on dividend income. 6. Potential for fraud. While mutual funds are regulated by the Securities and Exchange Commission, SEC, there is still a risk of fraud or mismanagement by the fund manager. Overall, investors should carefully consider the potential risks and benefits of investing in mutual funds before making an investment decision, and should carefully review the fund's prospectus and performance history. It is also important to work with a trusted financial advisor to help make informed investment decisions. How can we invest in mutual funds? Steps to invest in mutual funds? Investing in mutual funds is a simple process that can be done in a few steps. 1. Determine your investment objectives and risk tolerance. Before investing in a mutual fund, it's important to determine your investment goals and risk tolerance. This will help you choose a mutual fund that aligns with your investment objectives. 2. Research mutual funds. Once you've determined your investment objectives and risk tolerance, you can research mutual funds that align with your goals. You can use online resources or consult with a financial advisor to help you identify mutual funds that match your needs. 3. Choose a mutual fund. Once you've identified mutual funds that match your investment objectives, you can choose a mutual fund to invest in. Review the fund's prospectus to understand the investment objectives, strategy, fees, and expenses. 4. Open an investment account. To invest in a mutual fund, you'll need to open an investment account with a brokerage firm or a fund company. You may also need to provide personal and financial information to open the account. Invest in the mutual fund. Once you've opened an investment account, you can invest in the mutual fund by purchasing shares. You can buy shares online, by phone, or through a financial advisor. 5. Monitor your investment. After investing in a mutual fund, it's important to monitor your investment and review the fund's performance periodically. You may also need to make adjustments to your investment portfolio over time as your investment objectives or risk tolerance change. Overall, investing in mutual funds is a relatively simple process that can be done online, by phone, or through a financial advisor. It's important to carefully research mutual funds and review the fund's prospectus before making an investment decision. It's also important to monitor your investment and review the fund's performance periodically to ensure it aligns with your investment goals. What is the best time to invest in mutual funds? The best time to invest in mutual funds depends on your investment objectives, risk tolerance, and the market conditions. Here are some general tips to consider. Invest regularly. One of the best ways to invest in mutual funds is to invest regularly, regardless of the market conditions. This is called dollar cost averaging, and it can help to smooth out the impact of market volatility over time. Avoid timing the market. Timing the market is difficult, even for professional investors. Trying to time the market by investing only when the market is high or low can lead to missed opportunities and potential losses. Consider long-term investment goals. Mutual funds are generally considered to be long-term investments, so it's important to consider your long-term investment goals when investing in mutual funds. This can help to reduce the impact of short-term market volatility on your investment portfolio. Monitor market conditions. While it's generally not recommended to try to time the market, it's still important to monitor market conditions and economic trends. This can help you make informed investment decisions and adjust your investment strategy as needed. Overall, the best time to invest in mutual funds is when you have a clear investment objective, a long-term investment horizon, and a well-diversified investment portfolio. It's important to avoid trying to time the market, and instead focus on investing regularly over time. It's also important to monitor market conditions and economic trends to make informed investment decisions. What are the different types of mutual funds? There are many different types of mutual funds, each with its own investment objective and strategy. Here are some of the most common types of mutual funds. 1. Equity funds. Equity funds invest primarily in stocks or equity securities, with the objective of providing long-term capital appreciation. Equity funds can be further classified as large cap, mid cap, small cap, or sector funds. 2. Fixed income funds. Fixed income funds invest primarily in fixed income securities, such as bonds, with the objective of generating income while preserving capital. Fixed income funds can be further classified as government bond funds, corporate bond funds, high-yield bond funds, or municipal bond funds. 3. Balanced funds. Balanced funds invest in a mix of equity and fixed income securities, with the objective of providing both capital appreciation and income. Balanced funds can be further classified as conservative, moderate, or aggressive funds, depending on the balance between equity and fixed income securities. 4. Index funds. Index funds track a specific market index, such as the S&P 500, and aim to replicate its performance. Index funds have low expenses and are typically passively managed. 5. International funds. International funds invest primarily in securities outside of the investor's home country, with the objective of providing exposure to international markets and diversification. 6. Specialty funds. Specialty funds invest in specific sectors, such as real estate, technology, or healthcare, with the objective of capital appreciation or income. 7. Money market funds. Money market funds invest in short-term, low-risk securities, such as treasury bills, with the objective of preserving capital and providing liquidity. Overall, the type of mutual fund that is best for you will depend on your investment objectives, risk tolerance, and investment horizon. It's important to carefully review the fund's prospectus and performance history before making an investment decision.